Hazel Webb again from Idaho Mortgage Loans, and I just want to chat with you today. Let's just review the last session that we did. We talked about the loan application and how that helps you as a real estate agent represent yourself better to your clients and kind of what that looks like. Once we have the loan application, we're going to give them a call, chat with them, get a little bit better idea of what they're looking for, kind of what their priorities are, and finish up anything that they didn't finish in the application. And usually they get about 30% done with the application and then they just kind of get bored. So give them a call, finish the application. Okay, and that kind of tidies that piece up. And then once that happens, the next step is then to pull their credit. So there's two options. Most mortgage companies have the ability to do a soft pull and a hard pull. There's a lot of misinformation out there on when your credit gets pulled and what that means as far as how that hits their credit scores. If we have clients with an 800 FICO score, the last thing they need to be worried about is an inquiry from a mortgage company. And then on the flip side, if you have somebody with low credit, you think, oh, well then we really need to worry about losing points for a credit pull. But we need to do a credit pull so that we can work with them and see what we need to do to help them get into a better position to be able to purchase a home. So it's really one of those things where we really do need to pull their credit. It's either to get you that pre-approval letter out there for putting an offer in on a home, or it's in preparation to get them into a better financial position to be able to move that next step. So back to the inquiries. It's generally speaking, we're talking about a 3-point hit. Where you really see a big discrepancy and a big hit to credit scores is, for example, let's say you go car shopping and you go through the dealership and you let them pull your credit. They are going to send your credit information out to multiple different financial institutions. Let's say 5. Each pull is, let's say, 3 to 4 points. So 3 points times 5. Now that's a 15-point hit to your credit scores. And then let's see something happens and you don't go through with it. And let's say 2 weeks later, you decide, let's go and try this again. You go through the dealership again and you let them pull your credit and they send it out to 5 different credit companies. Again, that's another 15-point hit. So now you have 30-point hit. So it's not to say that pulling your credit doesn't affect your credit scores, because it does. And just understanding just what a credit pull actually means. Now that's if we do a hard pull. If we do a soft pull, there's no hit to your credit score at all whatsoever. The downside to doing a soft pull is at some point in time we go under contract, we will have to do a hard pull. And so it's balancing that out. If we do a soft pull and then we do a hard pull and all of a sudden, surprise, we drop in points, it could potentially cause an issue. If we have a hard pull from the beginning, that credit report is really good for 3 to 4 months. So it's available for quite some time, and then you don't have to worry about getting a surprise at the end, and it really helps kind of establish a cleaner basis to work off of. But it doesn't mean that we can't do a soft pull versus a hard pull. So that just kind of helps you a little bit as far as that concerned. So our next step is we pulled their credit, whether it's a soft pull or a hard pull, and we look at it, we analyze it. The first thing that I'm going to look for is collections, bankruptcies, foreclosures. Make sure that enough time has passed from a bankruptcy or foreclosure so that we can actually look to doing that. The next thing is collections. Now, I hear a lot of, hey, we're getting our tax return back, we're going to pay off all our collections, and then we're ready to purchase. We don't want them to do that. Cash is king in the mortgage world. If you're talking to a client and they're talking about, hey, we're going to prep and then we're going to go talk to a lender, that's like saying, hey, I'm out of shape. I really, really want to go to the gym, but I'm going to get in shape first because I don't want to go to the gym and be embarrassed. I've done it. We've all done it. We don't want to go to the gym and be embarrassed. How are we going to get in shape without the tools that we need? And granted, at home, you can run and do different things. But what I'm trying to say is that don't wait till you're in financially good shape and then talk to a mortgage lender. I consider myself more of a financial coach in helping you achieve the goals, kind of similar to like a fitness coach, that they're going to help you work with what you have and see what they can do to make you in a better situation. All lenders are not that way. Some lenders you go to and it's a hard yes or no. You either qualify or you don't. I don't think that does anybody any favors. Again, think of a fitness coach, financial coach. That's more of what I try to do with my clients. Let's get them in a position where they feel comfortable moving to the next step. And analyzing the credit is a huge piece of it. So in the next piece of it, how do we analyze credit? Most mortgage companies have the ability to run a credit simulator that helps tell you potential points. So we're able to run this computer software program that has algorithms built into it of that. Okay. So in the next piece of it, how do we analyze credit? Most mortgage companies have the ability to run a credit simulator that helps tell you potential points. So we're able to run this computer software program that has algorithms built into it that allow us to determine, let's say we have $1,000 to work with, where's the best place that we can put that $1,000 to help us get the most points. Some people, we can simulate paying everything off, and guess what? It doesn't do anything immediately. So having that inside knowledge of being able to say, hey, is this going to help us? Or should we just kind of use this money we have somewhere else in a different spot? And we can tell you down to the dollar of what we want and how long that's going to take. The most important part of this, it's really important for you guys to start to speak and understand the language that lenders use. If I say, hey, I need 6 months with your client because of some credit that we need to work on, that's not 2 months. If they reach out to you and in 2 months they want to start looking at houses, you understand because you know that I run a computer software program that tells me exactly down to this. And then we need this much time to cure what we need to cure. When I say 6 months, it's 6 months. And understanding that is really going to save you a lot of time. We know exactly, pinpoint it. If we can save you time, it saves more time for you to be able to spend with another client that might be purchasing a little bit sooner, where this one, we can put them on a drip campaign for 6 months out versus showing them immediately. What we do when it comes to credit, the importance of getting your clients over to us as soon as possible and letting them know, hey, pulling your credit is not a bad thing. It's actually a tool that we use to help you get into better financial shape. When you have your clients, encourage them to do an application, and it's okay to go ahead and get your credit pulled. We want to help you in that next step. And that will also help you know how to structure your clients in order of priority and set them up for success in the long run. So that's the piece on credit that we wanted to share with you. That hopefully helps you understand a little bit more of our language, our time frame, and what we are really doing when we look at credit. We're just not looking at just credit scores. There's so much more that we analyze and look at and can help you move forward.